Okay, I want to welcome everyone to a new presentation from Idea to Funding. We have a presenter, Diane from Ascendus, and we're very happy to be partnering with Ascendus as an educational provider to our clients. Okay, yes, and yes, the presentation will be available online after the presentation today. So I do see that in the chat. But as we get started, let me introduce you to Boston Business Mentors, just in case you're new. Um, our goal is small business education. We do this in a variety of different ways. One, through our workshops and webinars. We also have strategic roundtables and networking events. So definitely watch for our newsletter, check on our website, and watch on social media because we are always adding new topics and new events. Another way we share information is through our website. There is a resource section. You can download templates, business plan templates, marketing plan templates, some financial reporting, different things like that. Also under there, and I call your attention to, are the blogs. We have a lot of really fantastic articles, some written by our own Boston business mentors, some written by some of our partners. They're all timely articles, and some of them are even industry specific. So take a look through those topics. They are searchable, and I'm sure there's something in there of interest for you. There is no doubt the most important thing we do is our mentoring program. And as I mentioned, our mentors are volunteers. So our mentoring is always free. A mentor can play different roles for you. They can be a sounding board. They can be someone who helps you plan to overcome an obstacle that you're seeing, or just to help you achieve your goals. We're there to help you at every step of the path, whether you're just getting started or you're ready to leave your business. We have mentors with all different skill sets that can assist you. So you can use that QR code there to apply for a mentor. I'll also put it up at the end just in case you miss it. I'm going to go ahead and pull my share down, and I see Diane's screen is there ready to go. And I'm going to go ahead and let her unmute and let her begin. And welcome, Diane.
Thank you, Teresa. Good afternoon. My name is Diane Bohorquez. I am the lending manager with Ascendus, and I am here today just to go over the process of preparing your business to access capital. Now, before I go and dive in, I'd like to introduce Ascendus and the work that we do. We are a nonprofit CDFI. I'm not sure if any of you here have heard of what a CDFI is, but CDFI stands for Community Development Financial Institution. And our mission is to empower low to moderate income business owners with access to capital and financial education. We serve businesses across the US except for the state of Vermont. We have been around for over 30 years. And right now we're able to offer term loans and lines of credit, again, only on the commercial side. Um, we are what you will call alternative financing. Our goal is really to fill that gap that's created when a business owner is trying to access capital through the traditional options. And we'll talk more about what those options can look like for entrepreneurs. But ideally, the best case scenario would be going to your local credit union, local bank, and being able to access their loan programs. Unfortunately, that's not always very simple, and there's a lot of requirements that are involved in that process, and not everyone's ready to meet those requirements. And so that's when we come in, offering a little bit more flexibility, trying to fill that gap and close that gap so that you are able to access the capital and then eventually be able to grow and build yourself up to be able to access those more traditional options. So that's in essence who we are. Now, for today, again, we're going to be going over how to prepare your business for capital. This is today's agenda, and please feel free to add any questions at any point. I'm happy to answer them. But we'll start with the basics of starting your business. Then we'll go into the importance of credit and how it is used when considering an application. We'll then go into how to get your business loan ready, and we'll end with an overview of your financial options, including the not very good options that are out there, predatory lenders, and how to avoid them. All right, so let's get started. Now, when you first start or have the idea to create a business, and you haven't already established it, you want to start with creating a business plan. And that's not something that you only want to do early stages, but it's also something that is recommended even if you already have an established business. Um, the reason why is that it's going to help you really understand what is it that you want to do, how and why. And it's also going to help you understand if you're already operating your business, how it's operating, where you want to take that business next, and really understand where it is now. So for starting your business plan, something that you can always start with is you have your idea. Let's come up with a mission statement. And for that mission statement, again, you want to think of that what, of that how, and especially the why. It's really nice when a business has a story that they can connect it to. Why did you decide to start a business? Why are you fulfilling this need? Um, and second, you want to define your location and market analysis. So that's going to be part of what you want to do with your action plan, with your business plan. Um, why are you choosing the location that you're choosing? What need are you solving? Who's your target market? What is going to be your marketing strategy? You want to contact your city and state to make sure that you understand if there's any licensing or regulation requirements that you need to follow to be able to establish your business. And you want to also decide what you want to do in terms of structure, who's going to be the management team, who's going to be your staff. This is also going to be really important because if you're trying to access early capital, so pure startup lending, it is really important that your team brings experience. So, who is going to run the business? What experience do they bring? How do I want to register my business? Do I want to be a sole proprietorship? Do I want to be a partnership, or do I have to be, right? Because there's also going to be requirements around how you can register it. If you want to be an LLC, a C Corp, an S Corp, a nonprofit, what implication does that have? How is it going to affect you in terms of filing tax returns? And so you want to think about all of that. Once you decide you can register your business for LLCs, corporations, you have to register your business at the state level. If you decide to be a sole proprietorship, you can register with your town. You also want to run a SWOT analysis, and that stands for strength, weaknesses, opportunities, and threats. Um, your strengths and weaknesses are internal factors, and your weaknesses and and your opportunities and threats are external factors. And you want to start thinking about all of these before you start your business and also as you're running your business. That's why I said it's really important for you to have a business plan at the early stages, but also once you have an operating business. You want to think of who are your competitors? What is your competitive advantage? What is making you different? What is making you stand out from the others? You want to develop a budget. And this part is really important if you're looking to access capital. You want to understand how much is going to cost you to start this business. Is there going to be another form of income? Typically, lenders, when a business is fairly new, and there's not really a historical set of financials that are going to say this is how the business is performing, they're going to want to see that you have other forms of income. So are you going to keep a job while you start your business? Do you have maybe some sort of rental income or benefits, social security, pensions, a different form of income that can be used when determining your ability of repayment of a loan. You want to think about your fixed versus your variable cost because that's also going to help you determine how you want to operate or how you want to start your business. Do you want to start right away with a storefront, or maybe you want to stay away from that for some time and go with a home-based business? You want to create financial projections, right? You want to make sure that they're conservative, that you do the due diligence to look into and explain how you're getting to those numbers. How will year one compare to year three to year five? And if you want to access capital, you want to also include a section or think about how much capital you need, right? And so when you develop that budget, that can help you understand how much money you're going to need to borrow if you don't have all of it in hand. Um, how will you use it? The purpose is very important, and we'll talk more about that, but you really need to understand how how the funds will be used and how it's going to help your business grow. All right, let me go on to the next slide. There. So some of the common mistakes that we come across when someone is starting to build their business or come up with this business idea is that they're not taking enough time to really understand their target market, not doing enough research. You really want to understand who is it that you are going to be serving, how you're going to reach them. That's also going to help you to choose your location and what you want to do in terms of inventory. So it will help you prepare better to run and operate your business. Unrealistic financial projections. So, of course, you want your business to do well, but it is really important that you have conservative projections that can be backed up. So you need to be able to support how you reach those numbers. Example, if you have projections where let's say you start with the calendar year, January, you start your business, and all of a sudden in June, summertime, your sales peak and they increase by like 70% or 50%. They take this big jump. It has to make sense. If you're an ice cream shop, yes, it makes total sense that in the summer months, we're going to see a peak in those sales. But if you are maybe like a ski rental company, summertime might not be your high season. So it wouldn't be realistic to see that jump. Your financial projections need to make sense. Another thing that's really important when creating your financial projections, and we often see, is that business owners don't include a salary for themselves. And if you are not going to be having another form of income and you're going to dedicate yourself 100% to the business, you need to be able to support yourself. And so the business needs to generate enough to support you. And it's very important that you include that in your financial projections so that you understand what's needed from the business to be able to support business needs and support your needs. When it comes to access capital, that's also very important because at the end of the day, what we want to see is that your business is generating enough to cover business expenses and your personal expenses. That's when it's a global analysis. So that's when we look at not only the business, but the personal, and that's often the case. Also, not considering competitors. That will help you with location as well, right? Like you don't want to open right next door from a business that's offering exactly the same thing you're offering. Or if are you going to be the only business offering that in your area? Um, If there are others doing the same thing, what's making you different, or how can you make your product or your service different? And not identifying your distribution channels. You want to, again, make sure that you take time in doing research and understanding and planning well so that you set up your business for success. Here we have a quote: failing to plan is failing to plan is planning to fail. Um, so it is really important for you to take the time and plan. Now, here are some statistics just for you to have an idea, and also get a sense why sometimes early on it may feel like it's really hard to access capital. And that is because creating a business is risky. And 20% of private businesses close in the first year, and 39% close within 3 years. And so there is a high chance of failure. And when someone is taking their money, right? Even if you think about yourself and you were to give someone money hoping that they're going to pay you back, you want to minimize the risk. And that's what lenders are doing. Now, you also want to keep in mind and think about the expenses that you have. Again, fixed costs versus the variable costs. Your fixed costs are expenses that you are going to have month to month, regardless of, seasonality, of what your sales activities are. And your variable costs, they can fluctuate from month to month. You may have them one month, you may not have them the next. And that will help you prepare and also understand if you are going to require funds, what exactly you would need them for, and plan for the future. Right now, we're going to move on into the next section, which is the importance of credit and credit basics. Um, we'll start with what is credit. And credit is just really this idea of buy now, pay tomorrow. It's your ability to borrow money to access a good or service and then be able to repay it back. Typically, is going to come at a cost, and that's often in the form of interest and fees. Credit is very important. It can help you as a person, but it can also help your business. Your credit is important if you are trying to accomplish different goals, including buying a home, if you're looking to rent an apartment, to borrow money, to finance a car, even to get an insurance policy. And even for some jobs, it plays a role. And then when it comes to your business, is going to help you grow, is going to help you increase capacity, is going to help you buy inventory, is going to help you buy equipment, obtain working capital, and also increase your negotiation power. Because depending on the business that you have, when you have a stronger credit profile, you're going to be able to negotiate better terms a lot of times. Now, your credit score is a number that can range typically from 300 to 850. We consider a poor score anything below 580. Fair, it's between 580 to 670, and then good would be above 670, excellent being above 800. For a lot of the lenders, they're going to want to see very good to excellent credit. Sometimes there are lenders that will go, or traditional lenders that will go with a 680 and above. Those are the ones that are more flexible. Organizations like us at Ascendus, we try to offer a little bit more flexibility in terms of requirements. So, for example, we're able to go as low as 575. Now, what your credit score tells the lender is how risky it is to lend you. And we want to avoid risk. The higher the score that you have, the lower the risk, or that's what's implied. I like to provide an example with a 30-year mortgage of how the difference in credit score will create different pricing. right? Because if it's riskier to lend to you, you're probably going to have to pay a little bit of a higher interest rate versus someone who's less risky. And so if we take a $250,000 mortgage loan to 30 years and we compare it here, you can see that someone with a good credit, they will get a 5.771% APR versus someone with poor credit who would get a 7.969% APR. The total that you see here for monthly payment, it's already a big difference, right? So it's 1,462 for the one who has the strongest credit versus $1,829 for the one with the lowest credit. But if you look at the total, that's just in interest. That's not including principal. That's the total paid just in interest. When you compare someone that has that 5.77% APR, they're paying $276,000 on interest versus the one that has 7.9, who's paying close to a little bit over $408,000. It is a huge difference over time. And so this is something that you should think about when it comes to borrowing. You want to really understand the terms. You want to go for the best terms, ideally, and have a lower interest rate because over time it adds up. With smaller amounts, with smaller loans, it would not be as big of a difference. But I like to show this example with a long term so that you can really see the impact of having good credit. It is really important for you to work on that. Now, here are the different factors that affect credit. Um, the biggest ones are payment history with 35% and the amounts you owe with 30%. This is referring to the FICO scoring model. Now, there's different FICO and credit score models and versions. And so that's why from time to time, if you go into one of your apps that allows you to track your score, you may see a different score than what you see maybe with your banking application that also allows you to track your score. And that is because there are different versions out there. For the most part, they'll still be very close, but there'll be differences. This is here specifically referring to what factors affect the FICO scoring model. Then you have the length of credit history, which is 15%, the types of credit use, which is 10%, and new credit, which is 10%. Uh, just by looking at this here, you know that it's really important to make sure that you maintain good repayment history. A late payment, a collections account, a charge-off account, any negative unpaid history is going to affect your score significantly. When it comes to amounts owed, is just it's your balance, right? Ideally, when you're looking at your limits, you want to use less than 30% of your credit limit. That would put you in a good place. Ideally, best case scenario would be below 10%. You want to be below those percentages. When it comes to the types of credit use, you want to make sure you diversify. You want to have not only credit cards, also not only store credit cards because they're looked at a little bit different than if you get just a regular bank credit card. The length of credit history is also really important. You want to make sure that you keep your accounts open. And so if you have multiple credit cards and you're thinking that, I might need to close one or two because I only want to keep three of my credit cards open. If you're having to make that decision, make sure that you do not close the one that you have had for the longest. If you close your oldest account, that's going to affect the length of credit history even though it stays on your credit for some time, it will affect your score. And new credit just refers to increase whenever you're looking for funding or applying for any type of capital. You can have a hard inquiry on credit or a soft inquiry on credit. Hard inquiries will affect your score. Now, something that I also like to touch on is your credit history. Sometimes we use it interchangeably, but they're not the same thing. Your credit history and your credit score are not the same. The score is a number. The history is it's a written summary of what's in that history. And so that includes your payments to credit card accounts, to loans, to mortgages. Also, it can include utilities, bills, medical bills. It will include unpaid debt. So anything like a collections account, a charge-off account will be reported on credit and can stay on your credit for up to 7 years. Bankruptcies, which are public records, they're also reported on your credit and it can stay on your credit for up to 10 years. Um, Traditional lenders don't like to see bankruptcies. They also don't like to see a lot of late payments or derogatory items on your credit. With alternative lenders, we try to be a little bit more flexible. So as an example, we are okay with bankruptcy so long as they don't involve the business and are discharged for at least a year. But that's something important to keep in mind if it's something that's in your credit history. You want to try to look for a lender that might be a little bit more flexible around that. And again, credit increase. If you've had recent increase, they are reported on your credit history. Now, if there are any derogatory items on your credit that need to be addressed, it is important that you do um, take action. It's not good to have late payments. It's not good to have charge-offs or collection accounts. But if you try to do the right thing and you try to get back on track and bring those accounts current, it will also show on your credit. They will reflect as, late in the past, but then current at the time. If you have collections or charge of accounts and you pay them, they will show that they were paid. And so it shows the intention that you had of doing the right thing and getting back on track. If you are running late or will be or know that you may have a late payment, reach out to your creditors. You'll be surprised. More often than not, they're willing to negotiate with you so that you stay current and that you make payments. So always reach out, stay on top of your credit, make sure that you have good on-time repayment history. And if you have damaged credit and you don't have, and your accounts have been closed, or you don't really have a way to get your credit working, because in order to build your credit, you need to be working your credit. And so that's built with your payment history. And if you have bad credit, a lot of times it's hard for you to access credit. One way to do so is through a secured credit card, and you can talk to your local bank or credit union about the options that they have, so that you can start doing that to repair your credit. Here is the information for the three major credit bureaus here in the United States. You can get a free copy of your credit from each of them. There is also this website, which I really like to use, which is annualcreditreport.com, that allows you to pull a free copy of your credit at least once a year from each of the bureaus. And you can request it online or you can request it by phone. And so if it is always good to have this information handy, it is recommended that you look and review your credit at least three times, 3 to 4 times a year. There can be times where there's fraud and or there's information misreported, which you can try to get corrected and fixed, because again, it is the credit is going to be a key factor when accessing capital for your business. A lot of lenders will have minimum credit requirements. If not minimum, there's kind of a threshold where they don't really go under. And so you want to work on that credit score and credit history. Now, getting your business loan ready. Um, when you think about the business, your business is all about generating income. So you're either selling a product or a service and you're earning money, and you're if you have enough funds left, you can maybe save some money for emergencies and for the future. Um, but a good way for you to really understand your financials and make sure that you can plan for the future is by keeping good financial records. And that includes tracking. So if you have a POS system, your bank statements, QuickBooks, a cash register receipts, whatever it is that you decide to use, you should be consistent and you should make sure that you are using it correctly. This will help you track costs so you can understand better your business. You can also identify trends. You'll be able to understand if your business has seasonality. You'll also, if you offer a product, you can understand which ones are your best sellers. You can prepare in terms of inventory, and that will help you plan for the next step. Also, when it comes to accessing capital, because if you understand these trends, for example, if there's seasonality with your business, when it comes to requesting funds, you want to be at a good spot. You want to be able to show, hey, my business is generating income. My business can support the repayment of a loan. And um, if you have seasonality, you probably want to go and apply for that loan during your strongest season of the year to prepare for the low season. So you want to do it ahead of time. You don't want to wait until it's an emergency, because at that point you're better off just relying on your savings. It would not be very easy to get a loan during emergency times. Now, again, when it comes to record keeping and using your business bank account, something that I often come across is the commingling of personal and business in the same account. Um, it will really make a difference. It will make you appear more formalized and organized if you keep those separate. Also, at the beginning, I mentioned making sure that you think of your salary of your pay. A lot of times when the business is very small, you're just getting started, you might use your personal account, and so everything goes in there and you pay for your personal expenses from there. Or eventually when you get your business account, you might find yourself paying for gas or for the coffee in the morning or for a trip from your account, and that it's going to make it a little bit difficult for the lenders to really understand what's the true cost or true expenses for your business and also true business sales. Because if you have funds coming in not only from sales, but maybe from a transfer, from a Venmo or Cash app that not necessarily will always imply that's coming from the business, then you're putting yourself in a situation where it's hard to understand what is business related and what is personal. And that could hurt you in the long run, because if you have, let's say, a bunch of expenses and debits on your business account that are personal, that are going to maybe cover some of your personal expenses, like your rent or your auto loan, that's on the personal side, that may be considered a business expense because it's coming from your business account. You want to transfer any pay owner's draw or pay to yourself and then use it from your account. That way I can see, okay, the owner is taking those funds for themselves. They're not necessarily just expenses that I'm seeing month to month. Also for, tax purposes, if you were to ever get audited, you want to make sure that you can support the expenses, what you're labeling as business expenses. Nowadays, you have access to years of transaction history, and so that will always show what the funds were used for. Now, cash flow, it's another very important aspect. A lot of profitable business, or a lot of times really strong profitable business can lack the cash on hand, and that would hurt them. Um, a business can be profitable, but if you're not able to have cash on hand to cover those daily expenses, it's going to be very hard to operate the business month to month. And so it's something that you want to make sure you have and you prepare for. When it comes to accessing capital, something that's really important to the lender is that you have a strong cushion on your account. And that just means that you have funds that sit on your account so that the account never goes negative. You don't want to have overdrafts, you don't want to have non-sufficient funds, because that's going to affect your eligibility and is going to create higher risk. And so it's really important for you to understand the flow of cash in your business and plan for it. And that brings us to the importance of savings. If you are able to have this cash cushion, doesn't have to be, the a big lump sum, but just enough that will cover any emergency in case a large transaction comes through, so that you are never going to be in the red. That's really good. And also, you can set it aside in a savings account where it accumulates interest. That's going to help you again when it comes to seasonality, if you have any unplanned emergencies, because accessing capital can take time and is not going to be very easy when you have an emergency and when you need the funds by today, which is a lot of times what we run into, what we see. And collaterals and cosigners. Something that you may be required to present when applying for a loan is the collateral and cosigner. The collateral is just a tangible asset that you're pledging to secure the loan that would serve or give the lender some peace of mind that if anything happens and you're unable to pay the loan, they can take the collateral and use proceeds from that to make up for any loss. And a cosigner is when you have someone co-sign the loan, so also be a part of the loan and be legally responsible for paying that back. Those are oftentimes required when it comes to accessing capital, but every lender is going to have different guidelines. And now for our last section, we have an overview of the financing options a business will have. Now, we have typically at the early stages, it's easier, or business owners find themselves borrowing for friends, tapping into their savings, using resources like crowdfunding. All of the options for borrowing will have different costs associated. So when it comes to borrowing from friends and family, sometimes the cost would be at the relationship level, right? Depending on whether or not you're able to meet the terms that were agreed. Crowdfunding will have there's different options, and so there might be equity involved, there might be interest involved. It really depends on what options you decide to go with. There's also the option of using credit cards, personal credit cards. That's typically not the best option, um, especially because credit cards can have a very high interest rate. The average credit card rate is about 25%. And so you don't want to use a credit card for something that you might have to take a long term to pay back. Then you have options like Ascendus with microloans where you're able to access smaller amounts and have a little bit more flexibility, although the interest rates are a little bit higher because the flexibility again comes at a higher cost. We don't have abusive terms, and so you will not be getting anything predatory, but it will definitely be higher than your traditional options. Then you have regular term loans that your traditional options offer, banks, credit unions, including SBA loans. Microlenders or alternative lenders will also have options for SBA loans. We offer SBA microloans, which can only go up to $50,000. It's an option we have available. And then you have the option of having investors or that typically will want equity on your business or interest paid. So there's always different costs of borrowing. With alternative financing, there's many options out there. You have a rise in online lenders, which they're not often regulated, and so that's where you can get in trouble and end up borrowing from a predatory lender that will have abusive terms and trap you in this cycle of debt. So it's really important for you to really understand what the options are out there and what makes sense to you and what you can afford. Now, to prepare yourself to apply for a loan, you want to make sure that you have your financials ready. And so we talked about the business plan. If you're in early stages, you definitely want to have that business plan and financial projections ready. If you've already been operating, you want to make sure that you have your historical financials. And so personal tax returns, your personal credit cards, reports, pay stubs. You want to be able to support that. You have additional income. You want to be able to show what you're doing on your personal side. If you file your business taxes under your personal tax returns with the Schedule C, you want to have all those ready and available. Ideally, lenders want to see profitable tax returns. There is some flexibility around that depending on the lender that you go with, but for the most part, you want to have profitable financial statements. On the business side, you want to be able to provide corporate documents, licenses, permits, business tax returns. You want to be able to provide profit and loss statements, balance sheets. If you use any third parties like PayPal, Etsy, Square, be able to provide statements from those accounts. If you use a POS system, you need to be able to generate reports so that you can present them. And other supporting documents can include contracts, purchase and sales agreements, photos of your business. All of these documents will likely be required in the application process. And again, if you have them ready, that's going to make the application process smoother for you. And now I'd like to dive into predatory lending. Now, predatory lending is any lending practice that imposes unfair or abusive loan terms on a borrower. It is also any practice that convinces a borrower to accept unfair terms through deceptive, coercive, exploitive, or unscrupulous actions for a loan that a borrower doesn't need, doesn't want, or can't afford. And I like to use this photo because, as you can see, sometimes known as shark loans, they might charge you an arm and a leg for it, and still need a little bit more. So it's something that you probably want to stay away from, um, so that it doesn't drain your cash flow. Here are some of the ways, or some of the practices from predatory lenders. That includes inadequate, hidden, or false disclosures. Sometimes they will not advertise all the fees, all their terms. Is going to be really hard to understand what terms you're getting into. They have unfair risk-based pricing. And so a lot of times they are not going to run your credit. So they might say, oh, no credit check. But because they're not doing the due diligence, they don't really understand the risk. And so they're just assuming it's very high risk to lend because there's not a lot of background check or analysis to determine your ability of repayment. And therefore, they will charge very high interest rates. And again, they can also have fees, and charges that are not fully disclosed. And so they'll have structures where they'll have, in addition to maybe an interest rate, a weekly fee or a monthly fee or um, a enrollment fee, that's not fully disclosed. They'll also have abnormal repayment penalties. You If you decide to pay back the loan early, they might charge you for doing so. I was just recently talking to a business owner who had to get an MCA, and they mentioned that they were able to pay back the loan early. And when they made the lump sum payment, they received an email with deceiving wording. It was kind of saying, hey, here's our reward, which was a fee for paying back early, but making it sound like it was an accomplishment that they were able to pay back the loan faster. And so there was a fee associated with it, but there was celebration of being able to pay back the loan early. There's also contracts that make it illegal for the borrower to take future legal action for fraud or misrepresentation. Aggressive sales tactics. They just want you to get the loan fast, not don't ask a lot of questions, and end up trapping you in this debt cycling, where they just, before you're even done paying for a loan, they start offering you a refinance to get more funding or to renew the loan. And so, tying it back to what we just went over, these are some of the things that you can look out for to avoid predatory lending. Typically, if it's too good to be true, it's because it is. And so, always take the offers that you see with a grain of salt, be skeptical, um, ask questions. There may be good offers out there, but that's not going to always be the case, especially if you have um, maybe problems with credit or your financials are not the stronger, because these lenders are looking for people that really have this need so that they can trick you into getting and signing these abusive terms. Also look out for this an organization that discourages questions or transparency. If they're not willing to answer your questions, if it's hard for you to get a hold of someone, typically um, I recommend that you look for a person to talk with and to be able to ask questions. Because if you just go online and fill out a form or answer 3-minute questionnaire and get a pre-approval, um, then also think about what's the process going to be like in the case that you need to speak with someone, in the case that you need to ask questions. Is it going to be easy to reach a person, or are they going to have you do everything online and just speak to a computer? Look for hidden, misleading, and restrictive contract terms. Um, Again, they will try to word things differently in a tricky way. They might not disclose the interest rates, or it may be a structure where it's not necessarily a rate, but they're charging a fee of, let's say, $25 for every $100. And so work out the math and try to really understand what that means. Other things to look out for are excessively high interest rates and fees. Again, they are not regulated, and so oftentimes they can disclose rates that are not necessarily annual percentage rates. And so you want to look out for the APR. You want to understand what the annual rate is. There's a lot of promotional misleading advertisement where 3% or a 4% rate will be promoted, but the reality is that um, that is a monthly rate and not necessarily an annual rate. Um, Look out for aggressive sales tactics. Again, if they're just trying to push you to sign a contract, not read, not ask questions. They want you to refinance again and again and again. Um, that's not suitable. And also look into the repayment structure. These organizations will oftentimes have um, daily or weekly repayment structures that are very difficult to sustain for businesses that don't have a daily influx of cash, and will end up draining your cash flow, hurting you. And then that's where they trap you in the cycle of debt, because you end up needing to borrow more to keep up with the payments. And so that is it for me today. I will open it up for questions if there are any. Thank
Yeah.
you so much for your time.
Well, thank you so much. Yeah, I don't have any questions submitted quite yet, so we'll give everyone just a quick chance to get typing into the chat because this is really your chance to do that. Um, I'm going to also throw up our thank you slide there with the link to get a mentor because we can help you with all those steps that Diane went over today, from the business plan to getting your financials in order, all those things. So definitely take advantage there. Um, and I'm still not seeing any questions. So we will go ahead and wrap things up. Please watch for the follow-up email. It'll include the recording. It'll include some different pieces of information that pertain to this presentation today, and contact information should you want to reach out. So thank you, everyone, and then have a great rest of your day. And thank you, Diane, for your time today.
Thank you. Have a great rest of the day.
Bye.
Bye.